Hello, everyone, and good afternoon to everyone. And thank you for joining us today on a very interesting topic that we would want to share with you, which is on the quarterly earnings update. We have seen that the equity markets over the last 1 year have shown significant amount of volatility. And the good news for us is that after a year, markets are now trading almost at the all-time high levels. Surprisingly, today, the rupee breached the important level of 90 to the dollar as well. So there is, as we can see, a lot of volatility in markets, but some of the stocks and sectors are doing exceedingly well, and some segments of the market are not doing that well. What we plan to do today is to decode the quarterly earnings season, the Q2 for financial year 2026, cover the winners, the laggards, and also try and share the outlook on markets for the next couple of quarters. I'm very happy to have Harshad join me today for today's webinar. Harshad is head of research and also manages some of our hybrid funds as well. Harshad has been associated with Mire for now more than 8 years, and as part of his profile of being head of research, overlooks at the entire earnings seasons across sectors. So welcome, Harshad.
Thank you. Thanks, Vaibhav.
Uh, Arshad, like we discussed that, market has seen significant sort of changes and volatility in markets. But in the long run, we always say that markets are a slave to earnings, and markets are driven in the long term by mainly the earnings growth. In the short term, there could be a lot of factors which could drive markets, but in the long term, earnings do matter. We would like you to decipher how the sort of quarterly earnings has been for the markets. And before going ahead, I want to share a couple of slides with all of you. The first slide actually helps show the divergence of returns in various segments of the markets. So what we have tried to do is showcase the returns of the large cap index, the mid cap, and the small cap index based on the last YTD basis, 3 years and 5 year basis, and also showcase how the returns have been across various sectors. So clearly, if you can see from this slide, mid and the small cap segment was one of the best performing segments for the market, especially if you see the 5 year return for mid and small cap. They've been exceptionally high at about more than 20%. Large cap, to that extent, has been a laggard at about 12% return over a 5 year period. But when you look at the YTD return, the story actually changes. The Nifty is up close to 11%, while the small cap index is down -5%. So you can see there's a lot of difference between the returns of the mid cap, small cap, and the large cap index. When we move towards various sectors, you can again see that the divergence in return sort of continues. Let's focus on maybe the YTD numbers for the sectors. You can clearly see that auto has been one of the best performing sector with more than about 20% earnings growth, followed by metals, infra, and banks have also done quite well. But when you look at the other segments of the market, IT, surprisingly IT with currency at 90 has been one of the laggards, real estate, utilities, etc. Some of the sectors which had done exceedingly well, like real estate, over a 5 year period has seen a sort of correction. So we've seen a lot of divergence in the way returns have panned in the last year or so. And as we look at the backdrop of markets, let's look at how the overall economy was looking in the backdrop of the second quarter earnings season. We had seen that credit growth had started to inch up now, finally in double digit sort of territory, but deposit growth had been a laggard, where the deposit growth has been sub 10% and much lower than the credit growth. I'm sure in the subsequent slides, Arshad will decipher the impact that will have on banks and the other segments of financials, in their sort of overall result season. Surprisingly, crude, in spite of all the geopolitical tensions, has remained subdued, while gold has been on a clear tear away. Gold prices in India are at the lifetime high. We saw a small dip and they have again rallied significantly. Thankfully for us as an economy, few factors which are making India look strong is that the current account deficit remains fairly low and inflation is clearly inching closer towards zero. And that's where, earlier we had thought that the RBI rate cycle will take a pause, but with inflation levels being as low as current levels, there is enough talk of future rate cuts by RBI. And we have the RBI policy around the corner. So we will try and also see what the RBI might act in 2026. So the backdrop of the economy was quite strong um, for the Indian economy. And let's then decipher on how we see valuations to be across market segments. So, Harshad, coming to the first question from my side is that we've seen that there's been a huge divergence in the returns of market cap sectors. Economy as a whole looked in much better shape than maybe how the returns of some of the sectors have been. Maybe if you can help point out how do you see that the valuation sort of snapshot has been for the Nifty 50, and then we will take it to different sectors.
Sure. So for the initial discussion, let's start with Nifty 50 numbers because it is widely tracked.
Sure.
So Nifty 50, as you can see from the chart, this has been, I think, almost the sixth quarter of a single digit growth. Clearly, last year the toll or the impact was driven by the consumption sector, which has impacted, and it is still continuing.
Sure.
While government is doing various things, which will come to later, but nevertheless, from the reported numbers point of view, just to kick the discussion, is that the reported numbers was in a single digit growth. Even if you look at PAT number, that was also on a single digit growth.
Sure.
But the silver lining in this is that typically one looks at the trend, right? How
Correct.
much are upgrades to downgrades, whether numbers were in line or above estimate. So in that sense, if you look at numbers which were largely in line or above estimate, that was 74% of the Nifty companies reported, better than or in line numbers. So
Okay.
that way, I think looks like we are at the bottom out of the earnings downgrade, and incrementally things look better. Even if you look at the annual numbers, as you can see, FY25, it was a 1-2% growth on a Nifty 50. But on FY26, we are moving up to 8%, and FY27 clearly, is a very strong growth expected at 16%. And at the end of the webinar, I will show you, how it is not driven by just one or two sectors, but it's driven by multiple, sectors. See, I
Sure.
think FY26, according to me, will be a story of two halves. So first half will be like, single digit growth, which you already seen
Sure.
in the September quarter and June quarter. But I think in the second half, we will see a double digit growth. So
Okay.
5% and maybe 11-12% in the second half. So to that extent, we will have a 8-9% growth on a FY full year basis. I think that's what the backdrop is on a Nifty 50. But what we'll do from the discussion point of view, we'll focus more on BSE 200 numbers,
Sure.
which kind of covers broader collage or broader sectors. Yeah.
Sure. Yeah. Thanks, Harshad. So, uh, for the audience, I think the main important thing to decipher here is though that the earnings growth has been slightly slow for the last couple of quarters, the outlook next year and maybe FY27 looks quite strong. In fact, even the GDP numbers, if you see, the GDP print was quite strong. So hopefully the earnings season should pick up quite strong going forward. So Arshad, you sort of covered that our main focus will be on the BSE 200 index. So what we've tried to do is break the sort of overall sectors into basically 5 key buckets. One bucket that we call, which will be the largest bucket, is financials. So financials has about 32% weightage in the BSE 200 index. It covers banks, it covers NBFC, insurance companies, capital market entities, etc. So that's one part of the BSE 200. The second part is the consumption segment, which includes various parts: auto, FMCG, retail, consumer durables, e-commerce companies, etc. Now they are almost at 22% of the weightage. Third important bucket is the infra bucket, and very happy to say that recently we had launched an infra based NFO, and we got a lot of good positive response from partners and investors in this NFO. Hopefully we can share the final numbers by next week once the allotment is done. But infra, again, a very important bucket, and various segments are part of infra, whether it's capital goods infra, utilities, oil and gas, metals, real estate, telecom, etc. And that's again almost 1/3 as part of the BSE 200. Then you've got pharma and healthcare, which is just at about 5% in the BSE 200. I'm sure it's a very important sector, and in the coming years you will see a significant increase in the weightage this segment has, which includes pharma, hospitals, diagnostics. And the last is the IT segment. IT, of course, will be a hot topic considering that sort of rupee has crossed 90. So what we will try and do is discuss on these 5 important segments, and we will request Harsha to sort of give insights on each of this. So first we will start with the most important sector, financials, which has one of the highest weightage in the BSE 200 index at almost 1/3 of the allocation. So Harshad, how has been the result season in the financial sector? And there are a lot of elements of financial sector, so maybe you can start with the banks first.
Sure. So I think on the banks, clearly, as you showed, when you said the backdrop of the second quarter. So what we saw is that there is decent inching up of the loan growth. Now we are in a double digit number, but the issue still continues on the deposit side. Deposit
Right.
is still lagging, still in a single digit. But if you look from the banks, both private and PSU banks, I think they have done a decent job in terms of I would say mid double digit kind of growth, barring one or two private banks where there is a bank specific issues. But
Sure.
otherwise, I think the overall economic growth in loan is also reflected in the bank's loan growth. If you come
Sure.
to margins, I think the story, with Sky is quite expected while margins are trending down. But for the second quarter, I think the margins were better than, what one would have expected. I
Sure.
think the key reason, according to me, is CASA ratio has decently, hold up. And plus, if you look at
Okay.
the deposit side, it has, the cost of funds declined slightly faster. If you look at the segmental growth, on the third chart, which you can see, so I think we are seeing some offshoots on the corporate loan growth, some offshoots on the retail. Retail, as you recall, last year there was a lot of restrictions from the RBI. Now I think a lot of easing which has happened. So
Sure.
to that extent, both retail and corporate loan growth is improving. And most importantly, I think the asset quality. So there, I think asset quality continues to strengthen, barring
Sure.
few pockets. I think private banks, we are seeing, stress in the unsecured kind of easing. On the mid-tier side, there is some hiccup, I would say, on the small ticket MSME. But at a broader sector level, I think the asset quality is holding pretty much strong. If you think from the outlook perspective, on the banking side, I think one can expect a good second half. One can expect that NIMs kind of bottomed out in the second quarter, which was just reported. And I think from the valuation point of view, also I think it's a quite decent valuation in the backdrop of the growth. We'll go more in depth, what we prefer and not at the end of the
Sure.
financials discussion.
So overall, you are saying the outlook for the banking sector as a whole looks quite positive.
Yes, ROE profiles are tracking pretty well. Capitalization is pretty well. So I think this sector remains a favored, pick for us within, the whole, pack.
Sure.
So NBFCs, as you know, unlike banks, which is kind of a uniform, but NBFCs are basically sector-specific
Correct.
NBFCs. You have housing finance, you have gold finance, you have vehicle
Correct.
finance, and then there are many multi-liner NBFCs.
Sure.
But I think at a broader level, we have seen a 15% AUM growth for NBFCs. Within that, highlight is gold finance, where upwards of 45% AUM growth.
Would
The
be driven by gold prices.
gold prices clearly. And then HFCs at around 13%, and microfinance, I think pain still continues. As you can see, the negative number on the chart is the
Hmm.
microfinance loan growth, which is at around 13% negative. If you look at the names, unlike banks, I think there is a mixed story in terms of, while overall I think the names are slightly below expectations for NBFCs, but particularly in HFCs and gold, what we saw is NIM traction is slightly higher than the AUM
Eh,
growth. So these
Okay.
two segments clearly, stand out. Uh, if you look at again NIM trajectory, this is basically sequential comparison. HFC is largely stable. I think on the asset quality, things are again, I would say, mixed. The stage two has slightly increased for the business loan for the banks. When I said MSME, mid-ticket MSME, similarly the business loan lender stage two has slightly increased. And on the microfinance recovery, market was expecting an immediate recovery on the microfinance asset quality. I
Sure.
think that is slightly gradual, unlike
Okay.
sharp recovery. From the valuation point of view, clearly our stance remains same on the NBFCs. We will be a entity specific stance on the NBFCs, not a broader call. So
Sure.
whichever NBFCs are a triple A backed by a strong parentage, I think we'll prefer that. Most importantly, I think the underlying businesses which are supporting the NBFCs, there we are seeing uptick. For example, auto, right?
Sure.
So there is some uptick which is happening. So outlook is great, but again, it's a stock specific
Stock
call on the
specific.
NBFCs.
Sure. Then we've seen a lot of insurance companies,
Yeah.
capital markets entities are there. Maybe Arshad, if you can throw more lights on that segment.
So insurance, what we have done for the sake of discussion, obviously general insurance and life insurance. So let's start with general insurance. If you look at the industry premium at around 6% growth, versus last year, same quarter, it was 2%. So good
Okay.
uptick on a YOY basis. I think this is the last quarter where we'll see the impact of one by N in terms of accounting. From
Hmm.
next quarter, we should see a double digit growth on the, on the sector. Motor, I think, continues to remain steady, led by renewables. Incrementally, it will be renewables plus the new vehicle sales, which we are seeing. There is some pricing pressure, I think, but I think it has reduced over the recent period. If you look at the combined ratio, which is the indication of profitability, I think combined ratio for at least private multiliners had pretty hold steady. But the
Hmm.
issue is more on the PSU, the combined ratio, as you can see, the gray line has
Sure.
inched up significantly. So there it was more, cat losses and the Air India tragedy which has happened. So which kind of, impacted the combined ratio for them. From the outlook perspective, I think we can expect a mid double digit outlook, and valuations are comfortable at 28, 29, 25 to 28 times, I would say, valuation. On the life insurance front, I think growth was, I think, slightly better than expected at around 10%. Given given the volatility, or where the markets are, people are pushing more. I would say non-ULIP products. Basically, focus is more on profitability. But nevertheless, I think the agency growth has slightly picked up, but again lower than last year.
Sure.
Banca saw better trends, as the lower interest rates led to the higher guaranteed savings product sales. From the margin, or VNB margin, what we look at, it was better at around 19% versus 17%
Okay.
in 1Q. I think primarily driven by again push on the traditional products and protection. If you think from the valuation point of view, again, I think it's comfortable at 1 to 2 times price to embedded value. So to that extent, I think we, for now, unlike last few quarters where we were preferring general or life, now I
Hmm.
think we are largely neutral on the outlook from both
Sort of
general
both.
as well as life side.
Sure. So, Arshad, I know you gave a brief snapshot on banks, NBFCs, and insurance entities. I think you have a slide showcasing your final sort of summary for the entire sector. Maybe if you can run through this one, and especially banks, because when I see this chart, it shows that banks had a very muted growth for the last
Yes.
couple of quarters, and you remain very optimistic. That's one of the higher weights in this sort of index. Maybe if you can cover a little bit more on why we remain very optimistic on banks.
So I think the reason which I'm going to state now will be also common for many sectors. So if you look at last 9 months, 11 months, so
Hmm.
government and RBI has done multiple actions so as to boost the growth.
Sure.
We are just, I would say, in the first 1.5 month of the benefit of that all the actions. So to that extent, as I said, this year will be year of two halves. We do expect growth to come back in the second half.
Second
As
half.
I said, some green shoots on the corporate side we are already seeing.
Sure.
But I think between banks and NBFCs, if you ask me, we prefer banks over NBFCs given the valuation comfort. Capitalization is also quite decent and asset quality is also
Okay.
holding quite well. On the NBFCs, it will be a stock specific stance on the NBFCs, and also the other issue is banks are also becoming more competitive in the segment where also NBFC is operating. So to that extent,
Sure.
the current call is banks over
What the
NBFCs.
NBFC said.
And on the insurance, as I said, we are largely neutralish. We like now both general as well
General
as
and life
life.
insurance. Fair. So your team participants, we've sort of tried to decipher the overall earnings season for the financial sector and the outlook for banks, NBFC, as well as the insurance companies. Now we'll sort of move to the second very important bucket, which is the consumption oriented businesses. Now, what we've seen is that over the last couple of quarters, government has taken a lot of initiatives to bring back consumption demand to the economy, starting from the budget, where it handed over a lot of more um, funds in the hands of uh, I would say investors, employees, everyone to spend more money to bring the economy back on track. Then we had GST 2.0, through which rationalization on the GST rates have been carried out. So, what we will try and decipher now is consumption oriented businesses. And to start this discussion, we will first want to start with the auto sector. Um, Arshad, I was recently going to one of the showrooms to check auto demand, and
Okay.
at least the demand looks very strong, or at least the number
Yeah.
of people trying to buy cars look strong. And within that, a lot of demand is also looking positive for electric vehicles. Maybe at the backdrop of all of this, maybe if you can cover outlook for the auto sector.
Sure. I think the quarter which went by, if you look at overall auto volume numbers, X of JLR, we saw roughly around 13% volume growth. Within that, if you look at the tall blue bar, so that is a tractor volume growth at around
Wow.
31%. Two-wheeler and CVs were roughly around 7 to 8%. I think the important point to note here is trend, versus the subdued growth in the last few quarters.
Hmm.
We have seen a big uptick. Clearly, it is driven by GST cut. The only issue on the GST was, it was announced on the 15th of August and the implementation was on 22nd of
Correct.
September. So
Correct.
to that extent, people in anticipation of GST cut had delayed their purchases, rightly so, I would say. So that's the reason I would say this quarter is not the full reflection of the GST number, and Diwali also, happens
Correct.
later. So we'll also have to watch out third quarter, which I am sure will be
So you expect
similar
this quarter to be a much better
similar
one.
or better than the second quarter.
And is the tractor demand also suggesting that the rural consumption is seeing an improvement? Is
I think see, rural has been doing well for the last 2 years or so.
Hmm.
This year also monsoons were pretty well, but the only issue is this year is monsoon slightly got again extended. So
Hmm.
the last few weeks had done some damage on the crop
Correct.
side. We'll need to see, but I think it is holding well, I would say,
Sure.
versus last year. This is just a revenue chart where we can see revenues are growing double digit across the segments. I think margins after many quarters, I would say there is a definitive improvement on the margin front, partly due to operating leverage, partly due to the RM support. But I think RM, margin is trending quite well. And lastly, I think from the PAT numbers, it's just the reporting side. PAT numbers also, good double digit both on the tires and two-wheelers and three-wheelers. I think more importantly in the auto than the 2Q numbers is the outlook,
Sure.
which I think the if you look at the prices for the cars has gone more than 1 lakh rupees has reduction.
Correct.
So people to that extent we can see a entry level demand plus the premium demand even on the two-wheeler side across the segments. I would say
Sure.
we can see
See it.
demand growth happening going forward. Some hiccups could be there in terms of precious metal availability and all, but I think these auto guys trying to address that in
Sure.
some way.
So I think overall, I think we remain quite sort of positive on the auto sector. Coming to the second sector, which of course got impacted significantly from the GST, was the FMCG sector. Maybe Arshad, if you can decipher the FMCG results.
So I think what so first chart as you can see is the volume growth. So I think GST in fact unlike auto where we did see some growth in the last 1 week, but I think here it was slight more disruption I would say,
Okay,
unlike auto. So numbers were slightly subdued. So there was a negative operating leverage played out. There was a volume growth which slightly got impacted. But I think on a longer term basis, if you look at the numbers, there is some uptake on the volume growth which is happening. Urban, which was weaker last year, as you can see the middle blue bars, they were much lower last year. I think they are
correct.
trending slightly higher. So this quarter numbers one needs to excuse or one needs to adjust for
The
GST
disruption.
impact. GST impact.
Sure.
I think revenue growth again was slightly moderate. Partly the channel kind of delayed the purchases, so that's why revenue growth was also slightly subdued. On the RM side, I think I would say there is a descent. So when we say negative number, we have put it in green. So primarily because when there is a fall, which means it's a positive from the margin
Correct.
point of view.
Correct.
So I think on the food side, there is a descent decline which has happened. But the issue is on the oil product or there. I think the RM basket is slightly move inching
Yeah, just
higher.
for everyone, RM means raw material,
Yeah.
right? So we're just trying to say raw material prices sort of in green is positive. Uh,
And on the non-steppers, like, for example, paints. So
mm,
we saw some recovery happening on there. Even on the Alcobev side, there is some, healthy recovery, healthy growth, which happened during the quarter. Margins, as you can see, are slightly inched up, but not to that extent. I think primarily because the top line growth was slightly subdued. So to that
sure.
extent, margin growth was not that high. But I think the overall call on the FMCG for us is,
Mm,
while we like the companies, but we are meaningfully underweight on the sector, primarily because of the valuations.
sure. So it's a sector which I can say is an underweight call for us
Yes.
in the overall space. And considering that, you're not seeing significant improvement both in top line and bottom line, we believe that maybe the underweight call could work out better for investors. Now coming to retail, and we had the Black Friday very recently,
Yeah.
and there's a lot of news that Black Friday saw a huge surge in purchases, and recently we have few IPOs of e-commerce companies also there. So what would you say is how consumers are looking at this retail space?
No, I would say the consumer sentiment particularly continues to remain weak
Mm,
at a broader level. If you look at mass consumption versus premium consumption,
okay.
even in the recent period, what we understand, the uptick was more on the high ticket items,
Mm,
but we are yet to see uptick in the low ticket items. So you can say the consumer sentiment index, so that continues to remain subdued. So what has again, I think the inflation remaining lower from the outlook point of view, it is positive, but we are yet
correct.
to see the impact. But what you see more importantly, what has worked.
Mm,
So I think what has worked is value fashion. I think
okay.
that continues to do well. Jewelry continues to do well despite
Yeah.
higher gold prices. What is happening is that people are moving to lower caratage. So, but I
Mm-hmm.
think still continue to spend on jewelry. And I think grocery, after some long time, grocery retailers has also outperformed
Okay.
during the quarter. The reason also being, the shift from unorganized to organized, I think that still
There is.
continues on that side. Yeah.
Fair. So maybe Arshad, going to the other sort of segment. So you have building materials, which of course, a lot of real estate activities are sort of going on, and consumer durables. Maybe if you can share your outlook on
Yeah,
both
so
these
first
sectors.
let's look at consumer durables. So within that, I think wires and cables continues to do very well, good decent double digit growth
Sure.
because of I think the delayed monsoons and also early monsoons, right? So to that
Correct.
extent, there was an impact on the AC sales or ACD. I would say I think that impact was there in the second quarter also. Uh, if you come to building materials particularly, so there I think the story is different for each segment. I think plywood is slightly doing well versus what it was doing recently. MDF, I think after a long period of oversupply, now we are seeing that supply getting absorbed, so to that extent prices are slightly moving up. weakness I think continues on the tiles. But I think at a broader level, both if you look at building materials and consumer durables, we
Hmm.
think that they are led beneficiary of this real estate cycle, which was
Correct.
doing quite well.
Correct.
If you had to ask me for the next 12 to 18 months, I think this will be one sector where we will be quite positive. And from the
Okay.
management commentary also during the quarter, I think there is a lot of hope that the sector should do well
Right.
in the coming period. We are quite at across our portfolios decent overweight on both
The
these
building
segments.
materials. Fair. So maybe the last bucket on this is sort of internet or e-commerce led businesses.
Yeah.
And there is no, in the past, there has been a lot of noise on valuation of e-commerce companies and all. But the last couple of years, we've seen some of these stocks do exceptionally well and come back quite strongly. So maybe if you can decipher how's the sort of growth been in some of the segments within this place.
So I would say we are quite impressed despite the overall economic slowdown.
Hmm.
I think if you look at, for example, food delivery companies, right? Despite
Sure.
all the slowdown, they have shown almost a 17% YOY GMV growth. I think while it is weaker than what it was earlier,
Hmm.
but I would say in the backdrop of economy, it's a decent growth
Sure.
which is continuing. The profitability, or I would say the the take rates continue to remain strong for them. If you look at QSR, I think there is slightly a different story. Quick service restaurants,
Sure.
fast food. So there, I think the weakness still continues on the QSR front, which is more of a mass consumption item, I would say. On the beauty segment, where we have one listed player, I think the growth is again driven by the reinvestment. So
Okay.
unlike let's say food delivery or where the unit economics are getting more stronger. Here, I think we are yet to see good decent traction on the profitability side. And lastly, I think just from the data point of view, the digitalization or financialization through digital. I
Sure.
think the UPI, the kind of the trades which are happening, which is continuing quite well. I think no, as a whole, I think e-commerce is doing quite well. While basically these are all old businesses in the new bottle in terms of taking technology with the
Sure.
help of technology. But I think the trend continues shift from unorganized to organized. All that is getting captured, and most importantly, unit economics are getting better for the sector.
Sure. And I'm assuming that this segment as a whole will be a overweight call for you as a
So while I
cross
think,
funds.
yeah, at a portfolio level, these are small weights.
Hmm.
There are no benchmark weights really on that. So to that extent, I think we have decent exposure across these two three key segments which we like. Yeah.
Sure. I think so with that, we sort of come to the end of consumption as a sector. So this is the second large basket that we sort of discussed, which consists of auto, sort of consists of, travel, it consists of consumer durables, building materials, e-commerce, etc. Maybe in nutshell, if you can, Harshad, decipher the sort of overall earnings growth and the outlook for this entire segment.
Sure. See, I think India's story, is a consumption story. If you were
Correct.
to ask me in the next 5, 7 years, more so discretionary consumption is the, which
Correct.
will make a lot of money for you and me out there.
Correct.
But within that, I think just to, summarize what we're trying to say is that, auto, I think given a lot of government push, rate cuts, to that extent EMI is going lower. I think auto should continue to do well, but I think one needs to be stock specific because stocks has really done well. If
Hmm.
you look at the initial chart which you saw, auto
Correct.
was one of the best performer.
Correct.
So there, I think one needs to be stock specific on the auto front.
Hmm.
FMCG, I think what is happening is that while I think within that, I think food should do well according to me versus
Okay.
non-food because of higher grammage and consumption will be slightly higher. But FMCG for us is a more underweight call because of valuation.
Valuation.
Discretionary, I think clearly we are overweight on the discretionary as a space. I think per capita income increasing, younger population.
Sure.
I think the discretionary space should do well, and plus I think incomes getting this, for example, income tax cut which happened this year.
Correct.
1 year down the line, we will have the eighth pay commission. So I
Correct.
think money in the hands of consumer is very much there and happened to stay. Even at the state levels, we are seeing a lot of dole outs or schemes with the
Correct.
state elections happening. So I think discretionary should do well. Building materials, I think again overweight call for us primarily because of the late beneficiary of real estate cycle. Yeah.
Sure. So I think India remains, like Harshad said, a very important consumer-oriented economy, and that's a segment of the basket which we mostly remain sort of positive or overweight.
So
Within that,
maybe
you could have
if you can just
segments.
go back, few sectors which are not covered is this hotels and aviation, right?
Correct,
Given that there are small segments, but I think they both continue to do well. Only issue is one needs to see the supply versus demand. Sometimes it happens a lot of supply comes
correct.
in, but in that context, I think if I have to take a 3 to 5 year view, again we are positive on both these
Spending
segments.
pattern has actually changed a lot.
Clearly changed.
And when you travel across, you're hardly able to find any seats. Of course, now the flights have to go on time. That's another challenge
Yeah.
that we are seeing. But uh, of course, the consumer behavior of the young India has changed a lot. Now, coming to a sector which is clearly a very strong defensive sector, and always we believe is a strength of India, which is healthcare. And for a young economy as well as a aging economy, this is sort of a good balance that healthcare can sort of provide. So let's try and decipher how's been the outlook for the healthcare sector. And pharma remains one of the most important elements
Sure.
within this. And in the past, Harsha, there have been a lot of news flows that pharma was still insulated from all the US tariff news and all. But uncertainty, of course, remained in the news. So, how has the earnings season panned out for this segment of the market?
So I think one thing which I wanted to point out, unlike let's say 4 or 5 years back, when we say healthcare, actually it was just pharmaceuticals,
Correct,
either the generic players or
correct,
domestic players. Now healthcare is a very broad segment. You have apart from generics, now you have CDMOs, now you have hospitals, now you have
correct,
diagnostics. So
correct.
multiple sub segments
Has
to
started to
play
emerge.
within. But from let's say 2Q results point of view, I think what we saw is that US has slightly done better, while
Okay,
if you look at the orange line, the domestic has slightly weakened during the quarter. What has happened on the domestic side, that I think the results were mixed. Acute therapies continued to lag. So to that extent, there is a volume growth which is lower. While I think on the US side we saw some sequential growth. I would say in the other geographies apart from US also quite did well.
okay,
On the margin side, it was, I think, slightly lower sequentially. Not much to read into because it's a broader number. If you look at hospitals, there I think on the hospital front, the utilization level continues to remain largely steady. But 2Q is a seasonally pretty strong quarter. I think that was reflected, in the during the quarter. Margins saw slight impact on account of new bed additions. If you look at
okay,
lot of hospitals or hospital are adding new either organic or inorganically. So new bed additions is slightly higher. So to that extent, till the time they get utilized, we saw some impact on the margin front. On the diagnostic front, I think the footfalls continue to be steady,
sure,
while I think companies reported low double-digit growth. But I think nevertheless, competition has slightly, if you look at last 1.5 year, competition has slightly reduced on the diagnostic front. So to
okay,
that extent, I think the discounting and marketing spends have reduced. So to
sure,
that extent, outlook continues to remain well. Obviously, it's a question of valuation.
sure. Fair point. So maybe a conclusion from your side on how would you look at the entire healthcare space?
So I think, as I said, it's not just pharma. CDMO is a new piece which has say CDMO, CRD,
Hmm,
the way you call it. So there we are seeing a lot of convergence or incremental inquiries happening. So to that extent, these companies are getting better valuations, and the business outlook is quite strong here.
correct.
Uh, so on the generic pharma, particularly when I say generic, it means export. So
Hmm,
there, I think valuations are reasonable, but we still continue to remain underweight and will wait and watch for the triggers on that side.
sure.
On the domestic pharma, I think we remain overweight on domestic pharma, while there is some slowdown happening, but nevertheless, I think market share gains shift from unorganized to organized, that is happening. Hospitals diagnostics, as I said, there is a long runway for growth,
Hmm,
but it will be a subject to valuation for each company. It is not a broader call, buy all hospitals. It's not like that. It depends what we like and what we don't like. Yeah.
sure. So I think we conclude with that the third important sector, which is sort of healthcare. Now coming to the fourth large segment of the market, which is infrastructure. and we've seen infrastructure has a lot of other elements. And last few years have been very, very strong for the infrastructure sector. Um, we always, in the past believed that infrastructure was cyclical, but the way things have changed in India over the last few years, I think infrastructure is moving clearly to a more structural story. And that was one of the reasons why we also launched an infrastructure fund after a long period of time, because we saw that transition happening from it being more cyclical to structural, and lot of new sub elements being included in the infrastructure sector, which were earlier not possible in the past. So I think so. Starting of infrastructure is of course capital goods and utilities. Arshad, maybe you want to start with this sector first?
Sure. So here we have summarized, for different segments. So let's start with EPC. I think it was a decent quarter, but slightly muted primarily because the monsoon quarter in the sense, and then the order backlog was also slightly
Sure.
lower. We do expect that in the second half, EPC should do well. Last year also was impacted because of elections. If you come to non-defense product side, I think decent growth. Primarily, I would say execution on the defense saw strong pickup.
Okay.
Uh, if you look at other products on the defense side, also numbers continue to be decent. But again, unlike the way there was growth in the last 4 5 years,
Hmm.
the government focus has slightly shifted towards boosting the consumption. But
Correct.
nevertheless, numbers are very large. We can
Sure.
still expect a decent 10 11% growth uh,
On the
going
defense
forward.
side. Okay.
This is again the government capex. We just spoke on that. On the utilities front, if you look at on a YOY basis, I think primarily the weather or the climate change is to blame, I think, this quarter. So I think because of extended monsoons on a YOY basis, power consumption was slightly weaker, and also the lot of focus on the renewables, and because the monsoons were higher, hydropower generation was also slightly higher. So to that extent, I think the traditional power uptake was slightly lower.
So Arshad, we'll go to the next sort of important sector, which is oil and gas.
Sure.
And in spite of all the geopolitical stress that we've seen, trade tariff wars on pressure on Russian oil, um, overall prices of oil have remained in a narrow range to that extent. How has this sector behaved from both manufacturing as well as on the retail part of it
Sure. I think this was one sector, which kind of boosted the results for, I would say, BSE 200 or a broader
as a whole?
as a whole. Primarily because, as you can, recall, government has allowed these oil marketing companies particularly to keep the prices largely flattish. If you can recall,
Correct.
oil has moved up and down, no, the prices have remained
Remained
flat.
almost the same. Yeah.
So to that extent, positive on the positive side, there is no subsidy to pay now, right? They
Correct.
are independent on their own; they can
Correct.
support themselves. But from the quarter point of view, if you have to look at the gross refining margins, so GRM, the way we
Correct.
call it, they were supported by the good diesel cracks, as you can see in the chart. So that is for the OMCs. Marketing margins were also strong. If you come to upstream companies, which
Mm.
basically the oil producing
Correct.
companies like ONGC, Oil India. So
Mhm.
there on a YOY basis, as you said, there was a lower oil realization. So to that
Correct.
extent, earnings are impacted, and the production not much to talk about, largely flattish to marginal decline. On the LNG front, which is very important because we import a lot of LNG, half of our LNG
Mm.
is imported. The prices remain subdued,
Mm.
but I think they are yet to the actual impact will happen if the prices go in a single digit on the dollar per MMBTU basis, which I think is expected in the coming period. On the city gas distribution or CGDs, the way we call it, I think there it's a decent but a still single digit growth. Margins were slightly impacted because they had to buy high cost LNG. So to that extent, margins are impacted. The sector as a whole is not uniform, unlike other sectors. But at a
Correct.
broader level, I think the theme is that government has kind of moved away, or their companies have become independent. So to that extent, there is less interference on the policy front. Sector continues to remain attractive, but over the 5 to 10 year period, there is a disruption in terms of renewables, or in terms of EV penetration. So we are cautious on the sector and remain underweight for now.
Sure. One other segment is cements.
Sure.
How do you see cements play out?
So cement, one needs to also look at the backdrop. Last year there was a issue in terms of election, so to that extent no ordering was happening.
Hmm.
But this year, now the ordering has just started. But at the same time, we had this GST change which is there. From the realization point of view, I think the demand particularly remained subdued,
Okay.
but the realization was again lower. So I think cement story, what we were expecting that should have picked up by coming month or next few months, but I think it slightly got delayed.
Okay.
From the quarter numbers point of view, numbers were decent,
Hmm.
but I think because of GST and government also being monitoring the retail prices,
Hmm.
I think we will see the real uptick more in the fourth quarter or beyond on cement side.
Sure.
Yeah. So this is more on the RM side and the margin front. So margin on a sequential basis was lower, but on a YOY basis was higher.
So coming to metals, and I think we've seen commodity prices see a huge, sort of volatility.
Yeah.
In fact, gold and silver has done exceptionally well, and I'm sure a lot of commodities continue to do quite well. So maybe what is the sort of outlook for the metals and mining sector?
So for the sake of discussion, we have divided it in two parts, ferrous and non-ferrous. Non-ferrous for us is, aluminum. So orange line, as you can see, the aluminum prices continue to remain strong.
Sure.
Primary reason being China has limitation, or they have curbed, I would say. I think they're roughly at 45 million ton. They are not able to, produce beyond that. So to that
Okay.
extent, aluminum remains well. Steel on the other front story is different. We are seeing weakness on the steel prices. Recently, the anti-dumping duty which was there on the imports in India, so
Hmm.
that has also slight, removed, and we are waiting for that to come back. There is also a lot of supply which is coming in on the steel front. So to that extent,
Hmm.
the prices are lower. On the I think raw material front or cost front, again they were benign during the quarter.
Okay.
So demand, I think we covered. Let's go to margins. I think on the uh, mar yeah. On the margin front, I think sequentially the margins was lower, primarily driven by lower realization. But I think from the outlook point of view, again, particularly for the ferrous, I think margin decline may continue in the near term.
Okay.
But on the non-ferrous or aluminum side, I think the margin should remain well. So from the outlook point of view, I think valuations are quite decent. We are quite hopeful. So to that extent, we are largely, equal weight. In some funds we are also overweight on this sector.
And maybe last part of infra is the telecom
Sure.
sector, which is now a duopoly, or a sector which has um, seen only maybe a couple of large players left. How do you think ARPUs and other things are changing within this sector?
Sure. I think the ARPU trajectory was quite strong, I would say. Despite no tariff hike, we saw ARPUs inching up. Two reasons. One, obviously, one more day during the quarter, and secondly, the mix change.
Okay.
So, particularly for the second largest player, we are seeing the postpaid connections percentage is increasing. So, to that extent, there is a decent ARPU uptick. Going forward, I think we are waiting. There is a scope for one more tariff hike. We don't know what could happen. It could take 6 months, 9 months, but I think from the outlook point of view, it's quite decent. If you move to subscriber addition, well, obviously, I think penetration is very much there, but I think the top two players continue to gain subscribers at the cost of a
The third
third player.
player.
Only respite for the third player is that the decline which used to happen has slightly got lowered. So
Correct.
kind of bottomed out there, and plus government supporting the third player. We don't know. Story could be different in this sector going forward.
Sure.
So I think on the 4G or 4G 5G penetration, I think that number has already moved to 79% of the total subscribers what we have. 79% already on 4G and 5G.
4G and 5G.
And if you look at only on 5G, I think that number has moved to 46%. If you recall last quarter when we spoke, the number was at 40%. So
Correct.
there's a descent. I think see India clearly, now roti, kapda, makan and internet. I think that
Yeah.
is what is happening. So
Maybe our
data.
maids and servants and drivers are using more internet than we
Yeah.
do.
So I think the data consumption continues. Yeah. On the margin front, I think very strong margins, almost 56, 57% for the second largest player. I think there is operating leverage. which is playing out. All the increasing ARPU flows down to EBITDA. So to that extent, there is a decent uptick on the margin front. Only I think the issue out here is on the valuation. So we think that large part of this positivity or profitability now, I think from the valuation point of view, is largely, I would say, at a fair value,
Okay.
not much room. So to that extent, we have recently cut some weights on the telecom
Okay.
side.
So maybe a final synopsis on the infrastructure sector, which is again a large segment with about 32% weightage within that. And again, maybe like Harshad said, very important sector that if India wants to touch $10 trillion, this is a sector which is most critical. Maybe a summary from your side.
No, I think clearly, if India has to grow, we need to invest in infra. And infra, as as we would have said recently, it's just not, roads and railways.
Correct.
So you have hard infra, you have soft
Soft.
infra. For example, data centers. And that's a
Correct.
new big
Mo-
theme
Big theme.
which is happening. But net, I think government spend will continue. Now, I think more importantly, or what we are looking forward is a private capex comeback. If
Hmm.
you look at last 4 5 years, government was the only one, which was spending on the infrastructure
Correct.
side. Private company in the last 5 years, what did they do with all the earnings? They have improved their balance sheet. Many companies have become cash rich. So
Correct.
to that extent, I think as the utilization moves towards 80%, 82%, the RBI number which is disclosed, we think that private capex will come back. A lot of subsegments like cap goods, infra, and all, they should start to do well. Cement, I said, slightly delayed by 3 to 6 months, but again the outlook is quite strong. So from the allocation point of view, incrementally, I think we would continue to allocate more and more toward the sectors, and it will be again stock specific. Unlike the story of last 2 years back,
Hmm.
incrementally it will be stock specific on the infra side.
Sure. Maybe Harshad, coming to the last sector in this space will be IT. And
Sure.
IT, we've seen last 1 year has been quite tough
Yeah.
for IT companies as a whole. A lot of news flow is there. Currency at 90, maybe that's something that should give IT companies some sort of benefit. Maybe if you can decipher how IT as a sector has done in this sort of quarter, second
Sure.
quarter.
So IT, I think, as initial, just I wanted to, the initial comment which you made, that rupee going to 90. So generally it is sentimentally positive, what I have
Correct.
seen in the last 10, 15 years. But eventually it is priced out, and clients kind of, take benefit of it. But nevertheless, from the reported numbers point of view, I think the tier 2 IT companies are doing quite well in terms of growth rates, where at tier 1, we are seeing a benign growth rate numbers. Orange line is tier 2 and the blue line is, tier 1. But within that, I think the BFSI, which is one of the largest segment, or the one which gives the business, as you can see in the second chart, the BFSI segment, I think, is holding quite well.
Hmm.
uh, as you can see, the large part of the IT business comes from US. So I think we are quite hopeful in terms of, in case US interest rates continues to go down, hopefully there will be solution on the tariff front.
Sure.
To that extent, I think confidence on the US economy as it comes back, we will see, the sector, doing well. But for the near term, I think, for example, the, let's say headcount additions on the listed IT companies quite lower. But
Correct.
on the other hand, from the Indian economy point of view, there is a lot of, I would say, emergence of GCCs, or captive
Correct. Correct.
centers. So it's not just these listed companies, but when we say IT as a sector, there are a lot of other, subsegments, which
Subsegments.
are also doing well. On the margin front, I think near term, obviously, it will be range bound some pressure. But I think from the outlook perspective, particularly, I think going forward, while the kind of projects which have moved from transformation to cost cutting, there is a issue in terms of how the AI will impact overall IT as a space. But I think a lot of things are already factored into the valuation. So to that extent, incrementally, I would like to turn positive on the sector than negative, given where the valuations are. But within that, I think as a strategy, one would be stock specific more on the tier 2, and given the size, have some positioning on the tier 1 side.
Sure. Thanks, Arshad, for sort of covering all the large segments of sectors in quite detail and
Sure.
covering the entire sort of earning season for all the sectors. What we will try and do is quickly take few questions from the audience, and maybe we have a couple of very important slides to showcase the outlook for future and markets.
Yeah.
And considering how the earnings season has been, or how you should position your portfolios and which segments of the markets to sort of invest in. Maybe Arshad, you can cover those segments and then we'll sort of take questions from the audience. So maybe culmination of how do you see the earnings
Sure. I think quickly,
looking like?
given the time, so if you look at what we're trying to show here is these are nothing but the earnings estimate from Bloomberg. So all the brokers, I think 40-45 brokers, so they gave out the estimates and how the earnings are trending. When you started the discussion,
Correct.
markets follow the earnings. That's what we're trying to do. So here, as we can see on FY26 and 27,
Hmm.
we are largely seeing the bottoming out of the earnings. So incrementally, earnings are slightly getting upgraded or
Correct.
flattish. So to that extent, I think we can say the earnings have bottomed out or now stable in the last few months. This is an interesting slide. So this is for the Nifty 50 earnings sector wise. So
Correct.
when I said initially, if you can recall, FY26 is a
Correct.
single digit growth and 27 is a double digit growth. If you look at last column, so many sectors we are seeing, growing at a double digit on a FY27 basis. I think barring a few global sectors like let's say IT or oil and gas where we have global impact, but all the domestic oriented, domestic facing sectors we are seeing, good decent growth at a Nifty 50 level versus 6% growth in FY26. We are looking at a 16% growth in
27.
FY27. If you
And what I think so also, Arshad, it's looking quite broad based.
it is
So
broad
it's
based.
not based on one or two sectors which
Yes.
have high weightage, which are driving it. So the earnings look sort of quite broad based. I know which should give optimism that if earnings growth comes back, markets should start moving, inching forward, and outlook for markets remains sort of more positive.
So on the valuation front, quickly again, the top left side chart is the Nifty 50 1 year forward. As you can see, its valuations are quite reasonable. I would say at least for the large cap side, it is now trending at a long term average. So not
Correct.
much to complain on the valuation front. On the mid cap side, clearly it is at a premium, but mid cap, as you can appreciate, the earnings growth is also slightly higher on
Stronger.
the mid cap front. ROEs for the Nifty 50 companies, good decent double digit growth out there. Yeah.
Sure. So I know valuation is not as big a challenge, Harshad, now, like it
Clearly not.
was maybe a year back. Maybe a summarizing of some of the points we discussed,
So I
Harshad,
think what
and which
summarizing,
segments we should sort of look at
sure,
investing.
sure. So second quarter earnings, as I said, was slightly better than expected. FY26 will be a story of two halves. We should expect and we can expect a double digit growth. And if
Sure.
I think there is a double digit growth in markets, I think should also kind of hopefully respond to that. Then on the macro front, I think see government and RBI have been quite prudent up till now.
Correct.
While on the global front, there is a weakness which is happening, but India clearly stands out. From the medium term perspective, there are number of growth levers like, consumption, demographics, financialization, unorganized to organized. I will not repeat those, but I think from the medium term, India story continues to remain strong. See, I think most importantly, the focus on PLI or manufacturing. I
Hmm.
think that is the next big thing which could happen, over the next 3 to 5 years. It's too early to call, but I think the
Sure.
early success stories are, quite encouraging. From the valuation point of view, I think, as I said, earnings have largely bottomed out. There could be some earnings upgrade incrementally. India premium to emerging market has shrunk. Now
Hmm.
it is, at a long-term average. So to that extent,
Most of the emerging stroke developed markets did exceedingly well in the last year, and India underperformed. So I would say a large compression has sort of also happened between
so I think
performance.
markets which did well was more driven by the AI story.
Hmm.
So, whether that is justified or not, time will tell.
Okay.
So India, obviously, we didn't have any such AI play directly, but I think the market which did well was more driven by AI. On the valuation front, as I said, large cap, trending at long-term average, not much to complain. 1 quarter down the line, we'll start looking on, FY 1 year forward again. So valuations are quite attractive vis-a-vis long-term basis. Within that, I think what one can look at is, large cap, large and mid cap, flexi, or multi cap funds one can look at, and hybrid obviously continues to remain. One can always invest in that. Most importantly, I think our strategy is more do bottom up stock picking now. That is what
Sure.
we are trying to do.
And maybe on sector funds, which sector do you
So
think?
clearly, consumption is the one what we like.
Hmm.
Second is I think financials. clearly, both would be the favored within the pack. Infra clearly the long-term story. Unlike, I would say, banking and financials, one can look from a 3-year perspective. Infra, one can look from a 5-year perspective. I think that's the
Sure.
positioning one can keep.
Sure. So thanks, Harshad. Maybe I want to just end by saying, markets, beautiful saying that, markets are like voting machines in the short term and like weighing machines in the long term. So the idea of investing is to remain patient, to look at earnings and valuation are the key parameters to drive future growth for markets. And what we try and decipher in this sort of webinar is to break down the earnings season, try and tell you how valuations of the market are, try and make it as informative for all of you so that you can make informed decisions on which segments of the market to look at investing. Uh, we will try and take as many questions as possible from the audience today. Also, please do share in your feedback about the webinar. What do you feel we can add to make webinars more interesting for you? So let us start by taking few questions. Uh, so first question, Harshad, from Mr. Harsh Kumar. If we get another rate cut, uh, will it take another 1 or 2 quarters for banks NIM to bottom out, NII to bottom out, and sort of what is the outlook for banks in the phase of interest rates moving down?
I think, yeah. So depends on the quantum of rate cut. But if you say, let's say 50 basis, just for the sake of discussion, if it's a 50 basis point, then there could be a 1 quarter delay in terms of, because the point is loan gets repriced immediately, but on
Correct.
the deposit front, it takes some time. But
Sure.
I would say one, if you have to take a broader level, it's a combination of where the names are and where the growth is.
Sure.
Now, I think I'm more focused or more enthused about the growth
Hmm.
than on the names. From the names front, I think it's largely this quarter or next quarter. I think that's not too much of an issue.
Sure.
But I think I'm more positive or looking forward, which bank, can give me a better growth. Because all the parameters like asset quality, capitalization,
Correct.
valuation,
Correct.
everything, is getting tick marked. Now it boils down to growth.
Sure. So we'll take a second question. This is a question from Mr. Ashish. What is your view on the power sector uh, as a whole? And you've seen a lot of focus on renewables. How do you look at power within that space?
So I think power, it's basically you need to look at value chain. So
Hmm.
it's power producers, and then whenever the capex happen, the guys who support that power capex, and also once you produce the capex, one needs to transmit. So I think the capex on the transmission particularly,
Hmm.
given that a lot of investments are happening on the renewable front, so I think the transmission capex will continue to remain strong. So that piece within the power ecosystem, I think we are quite
Sure.
positive. But I think on the production side particularly, I think one needs to slightly take a longer term view, primarily because I think the next big uptick in terms of consumption could come from manufacturing. So I think
Sure.
that is an evolving story right now. So for now, I would say within the power side, I would be positive on the transmission and distribution ecosystem, and for the rest, it will be stock specific.
Sure. Question from Nalini Das. Kindly show the slide summarizing the view on IT sector. So thanks for looking at the presentation so minutely. But Harshad, maybe what would be the summary for the IT sector, if you can maybe share that?
So I think on the IT front, there are two, three things, right? One is growth,
Correct.
uh, and within the growth, the quality of growth. So for example, what kind of projects you are getting, right? So now I think what is happening is I am getting more projects for cost cutting rather than transformational projects. So unlike the unless the IT companies get the transformational projects, I think that is the time when one can get very positive. So for now, it is a subdued growth because these are from the client's point of view also, they are not too sure whether to go for the big capex or not. That's point number one.
Sure.
Secondly, on the margin front, I think there is not too much of a worry. Particularly Indian IT companies are quite smart in terms of protecting the margin. But I think lastly on the valuation front,
Hmm.
I think valuations have largely bottomed out, particularly for the large cap front. So I think there is a base which has kind of there from the valuation point of view. I would be more hopeful and wait, as I said initially, I will wait for, let's say on the tariff side, hopefully incrementally, I think some positive news flow will come out of it. Then on the
Sure.
US rate cut front, I think there is a lot of talk on the US rate cut front. So incremental news flow for the IT, according to me, will be positive. Uh, Last piece which I have not touched is this AI disruption, right? I think the AI disruption over the last 20 years, we have seen the Indian IT companies kind of, being taking in stride whatever technology change happens. So while the business model will not be, ki number of people into per hour billing, it will be something else.
Mm,
But I'm quite hopeful in terms of, they getting also, benefiting, if not getting too much impacted from this AI change. But again, we need to see on that front.
sure. So, question from Saurabh, and before that, he said, "Great webinar." So, thanks, Saurabh, for all the feedback, positive feedback. A question from Saurabh is, "Can you share the outlook for the Nifty 500 for the next 2 quarters?"
So I think we covered 200.
Hmm,
And I think if I'm not wrong, from the weightage point of view, the top
hmm,
200 companies don't hold me for it, but I think it's at least 70 to 75% of Nifty
correct,
500
correct.
market
Hmm,
cap. So I think from the outlook perspective, it will not be too much different from 200. Only difference is in 500, you will see, many other subsectors, which are part of 500, which are not part of 200. And typically, the smaller niche segments happen to be high growth.
sure.
So I would assume without, I mean, I need to look at the numbers, but 500 growth would slightly
Will
be
be
higher
slightly
than
higher
the
than 200.
200 numbers.
Sure. Uh, there's a question. Attendee has not given a name, but what is the impact of US rate cut on the Indian market?
So I think we have been slightly more proactive
Uh,
than US in terms of rate cut, but it is all about relative. Right now there is a lot of disruption which has happened
hmm,
versus, historically the way we know between the correlations. I think US rate cut hopefully will help US economy more. So
hmm,
to that extent, it will help, the global growth to kind of stabilize or move higher. So to that extent, we should benefit. But for us, I think the more important factor is, the resolution on this tariff thing, right? So
sure.
till the time that happens, there is at the margin some impact on India.
Sure. So I'll take the last couple of questions. This is from Sekat Chaudhary. He said, "Brilliant presentation, very well covered." So thanks, sir, for your feedback. In
Thank
fact, if you can add a slide showing valuation graph for each sector against its all-time average, it will give them a better understanding. So maybe
you. We can
Arshad,
do that.
for the next time,
Next time we'll do
we can do it. So thanks,
that.
Mr. Sekat, for the feedback. We'll try and incorporate it in the next sort of session. Uh, Question from someone for 2026, maybe what is your outlook? And maybe that could be the last question, maybe second last question. Uh, so Harshad, how do you see markets behaving in 2026? I know
Sure.
difficult to say whether you had a crystal ball to say what will
No,
happen.
near term, obviously, it's quite difficult. But I think the point is, let's look at what has happened in the last 9 months, right? It started with budget where the government gave incentive for income tax below 12 lakhs. There
Correct,
is no income tax, right?
correct.
Then we had RBI cut rates by almost 100 basis point.
Sure,
Then we had this GST,
correct,
cut which has happened. Monsoons were also quite okay.
correct,
Festive season was also quite okay. Next year, not 2026, but somewhere in the latter half of 2026, there should be some benefit of eighth pay commission. So I'm saying कि consumption as a piece which was weaker in 2025, so
mm,
2026 will be much better
better,
than 2025, particularly from the consumption point of view.
correct.
Last year there was also issue of the general election, so to that extent, government projects were
Delay
stalled
and
or
stall.
delayed. I think they will come back on track. So I think particularly because of base effect, second is markets really not going anywhere in the last 1 year. So to that extent, some time correction has
Correct,
happened. So I'm more hopeful on 2026 driven by numbers
correct.
versus 2025. And hopefully if global growth supports or tariff resolution happens, then there could be additional positive to the outlook.
Sure. So thanks, Arshad, for sharing your outlook and a very candid discussion you had on many sectors. Thanks everyone for joining in today. It's been quite a long session. We wanted to cover the outlook for the markets, for various sectors as well. We try to take as many questions as we could. In case there are further questions, please do reach out to us. You can email to us, you can reach out to our local sales team uh, or through our partners, and we'll be very happy to address all your queries. And please do keep sharing feedback to us, because basis your feedback we can, you know, continue to uh, sort of interact more with you. So thank you everyone. Thanks Arshad
Thank you.
for joining in today, and happy investing to all of you. And hopefully 2026 presents much better earning season, as well as better returns for investors on the equity market side. With that, we'll end today's webinar. Thank you.
Thank you all. Take care.